Hi, Greg Weldon here with the Global Macro Strategy Report from Monday, September 22nd. Shout out to my brother. Happy birthday, bro. Today, we're going to do something a little bit different today. I want to talk about Jerome Powell and what he said last week, which frankly, once I went through every word, the transcript from the press conference, word by word, it was kind of jaw-dropping. I mean, Powell all but suggested one and done, not new string of interest rate cuts in a more direct and pronounced and directed in a specific way to get to neutral. That a restrictive policy remains appropriate. I take issue with that. And here's why. Because to eggheads and monetary purists, nothing else matters. All right? Let's jump ahead to what doesn't matter, which is everything else. Consumer cocoon, a credit crunch, a delinquency epidemic. We see a crisis in housing, deflation, disinflation in real income, in real retail sales. You know, you're talking about deflation now showing up in the service sector and signs of deflation in the labor market. But none of that matters outside of the labor market versus inflation. And because the labor market doesn't see massive layoffs, it says inflation is still a bigger risk, and therefore we need to remain restrictive. He's flipping the bird to every hardworking American, especially those that earn, less than $100,000 a year. But even now, the attitude of those earning above $100,000 starting to sour very rapidly. And I'm going to show you that. All right. And when you talk about those that are looking for work, he basically says it's a low job creation period. You're probably not going to find a job. But we need to see it get worse before we will go to neutral. All right? We're more neutral now, which is a ridiculous comment. There's no degrees of neutrality, not as far as I'm concerned. But when you read this through, you can kind of read this through. It tells me enough. I mean, it's labor versus inflation. That's it. Nothing else matters because you're an egghead. And when I say egghead, I don't mean it derogatorily necessarily, although in this case, it kind of is a bit of a knock because this is talking about being in the ivory tower. He even went so far as to call this whole thing of SEPs and putting together the statements and everything an exercise. It is. It's an academic exercise to these people because they're eggheads. They're monetary purists. It's one or the other. It doesn't matter. Nothing else matters. And in this case, when you have a consumer that's choking, you have you have a credit deflation and revolving credit only twice before, 2009 and 2020, and now. I mean, there's crises out there. And Powell is like, well, we don't see enough job loss yet, okay? And when we do, it's such a bad environment. And he says, if it were healthier, it might be better when we do hit that point because then people can find jobs that lose their jobs. But no, right now, no. You lose your job, you're screwed. And this is Jerome Powell saying, oomph, if you lose your job. That's it. Sorry, it's the truth. You know me, I try not to criticize. Anyone's listened to me for a long time. I tread very lightly when it comes to the Fed. I very rarely criticize them. I mean, just because they're eggheads doesn't mean they're stupid. These are smart guys, okay, really smart, almost too smart. Because it's an indecision. It's a lack of skin in the game. It's a lack of action. This is all theory and exercises and what if, and it's like, sure, we do some of that too. What if? But then when we see what if scenarios, we act upon it. They don't act. They're behind the curve every time. Powell has missed the boat every single time in the turns, and he's missing it again. And this is going to really be a problem going forward because by the time you act, it's too late. And you have to act because of all the debt. Because if you can't service the debt, you have a debt deflation in pancakes rather than we can spread this out over the next 30 years and depreciate the dollar by 90% again and again and again. And yeah, inflation is going to be higher. And guess what? We have to acquiesce to that to make sure we have growth because growth is needed to service the debt, which is now the third largest expense in our federal budget. We talk about all of this because we're going to go back through some of the stats from the last month and then look at exactly what Powell said. And the stats include the Fed survey of the consumer, the Fed Beige Book. It's the Fed's own evidence that they're not even listening to. Woo! Yeah, this is a good one. Consumer price index. And again, we're replaying some stuff. So bear with me if you've seen this. If you haven't, it's good that you're seeing it. CPI 0.4. No big deal, 0.4. It's the second highest of the year since January. All right, and when you talk about an annualized rate and understanding, it's not mathematically perfect, okay? You get it, all right? Just let's make the math simple for the non-math people out there. 4.4 is 4.8%. Let's call it 5% annualized. 5% annualized. Food was 0.6 over 7 annualized. Energy, which has been deflating and been the major drag on inflation, has been the reason that the inflation has decelerated to the degree it has. First, you had food. Then you had shelter, and energy overlapped some. Shelter's now flattened down and actually starting to rise again. And now you see energy is the last one that's going to bottom. And this we call the bottom in inflation. Fourth quarter last year, we're a little early. It's really fourth quarter last year, first quarter this year. Really from October to April is when all of these stats bottomed, including CPI. Look at PPI in March, was minus 0.1. Now it's back up to 0.4. I mean, it was deflation. Now it's back to around 5% annualized. Energy, 8 annualized. Shelter, also 5. All three have annualized numbers higher than the year-over-year rate, which is a sign of acceleration as if moving averages were crossing over. 2.9, it's up 60 basis points from the April low. It's the second highest of the year, and it's the second non-pandemic high since you've been coming down. So on the upside. And this is still all with gasoline at minus 6.6, even though it is getting closer to zero. When it hits zero, these numbers are going to be higher. Hello, McFly. Food 3.2 up from 2.9, back above 3. Yeah. This is why the Fed doesn't want to cut rates. I mean, but they need to be to neutral. I'm not advocating stimulus here. I'm saying get to neutral. Before inflation rises and you're screwed and you're handcuffed, and now you are potentially seen as accelerating a move in the stock market, accelerating a move down in the dollar, accelerating maybe even a move in higher bond yields and a steepening yield curve all over again. 2.9 is a high rate. You take this period of time out, okay, that basically associates to the pandemic. And 2.9 next to 2018, tied for the highest in 12 years. Hello? And breaking out after bottoming at 2.3 in April. I've done this before. This is another one. This was the What Me Worry, Alfred E. Newman, GMSR. All right, what me worry about service inflation? Dang well better. 3.6 overall. And here again, 65% above 3%, 40% are above 4%. There's now only 77. They cut them from 114, so they cut like 30% of them, a little bit more. And you have now 40%, the biggest bulk of any one grouping is above 4%. Next, of course, the 65% that's above 3%. There's also 18% above 5% year-over-year higher inflation. Only 28.6 are below the 2% target. Now, here's interesting. If they went to a 1-3% target range for the inflation rate, which is what I think they will do eventually, it's going to take them a while to get there, but this is what they should do, this is what they will do, because it gives them a little more flexibility. This way you could say you're in within range. The problem is, again, 65% are above 3%, which means even still 65% would be above the target range, even if it was 3% was the high end. That's how crazy service price inflation is. Let alone PPI, all right? And we're talking about food, 4.2, and trade at 6.9. You want to talk about the negative impact, and we'll talk about the positive impact of custom receipts off of tariffs in a minute. Not nearly what people want to make it out to be in terms of being good. It's not a bad thing. It's not going to fix anything. But here's the downside, is inflation in trade. We showed you this in the Logistics Managers Index. Higher inventory costs, higher transportation costs, higher warehousing costs. I mean, you have these costs rising. You can see trade 7% in PPI. And this is finished area. 3.3. Foods, 4.2. That was it for PPI? Oh, I thought I had one more chart. Same thing. And what's interesting about PPI is the headline rate dropped to 10th, was expected to rise 0.3, and everyone's celebrating because the headline PPI, which includes the raw materials, the intermediate materials, and the finished materials, all right, was 2.6 down from 3.1, so dropped 50 basis points. The finished PPI was up 0.4, even though you had a 2.5% drop in energy, was still up 0.4, and went from 2.6 250 to 320 year over year. 70 basis point increase, above 3 now in finished. Talk about deficits, all right? I mean, come on. I mean, what do you need to see? Gold window close, Volcker, recession with ZERP in 1990, tech bubble crash, housing market crash, global pandemic. I mean, just more, deeper, deficit. Not only 43 months of consecutive deficits in the global financial crisis, 26 during the pandemic. But you go back to the 426 months since August of 2008, 390 months of deficits. That's 92% of the time we're in deficit. It's chronic. And even with the 22 billion net positive inflow from customs receipts, custom duties, imports, the whole tariffs thing. 29.5 billion was the total. 22 billion positive flow. It's minor compared to the 345 billion. And people are saying, well, that's why we were better than last year here. No, we're not better than last year. First of all, this year, spending accounts for only 70%. Revenue accounts for only 70% of spending. Last year, for the first 11 months, same time, year to date, year over year, 73%. All right. In August, $345 billion deficit, which people are saying better because it's better than last year's August. And because we have this big bonus, 22 billion, less than 5% of the entire deficit add-on from tariffs. It's still the 10th deepest deficit in U.S. history, and the government spent more than twice what the revenue was for the third month in the 11 fiscal months of this fiscal year so far. It's irresponsible. It really is. Total deficit, we're looking at 2.2 trillion. Do I have the total deficit? No. 2.2 trillion. Be the third deepest ever in history. We're over the debt black hole. I mean, this is the macro event horizon. We talked about this. This was pretty steady growth versus debt. Then you had 2000, kind of accelerated a little bit, tech bubble crash. Then you had 2008-9, accelerated right up, and you were basically on the macro event horizon until when? Until the pandemic. And then it just went off the rails. It now takes, when you throw on household debt, to 36 trillion, all right, in public debt. I mean, you're talking 55 trillion in our debt, all of us, households, public, government debt's our debt. It's public debt. It's we the people. We sold it back to us and expect the government to pay us with a currency that buys 90% less than it did 40 years ago. Hello, McFly. I mean, come on. Oh, here's the other PPI chart. There you go. Now, talking about goods, and Powell's all worried about goods. 1.9. It's up from minus 4.3 in June of 23. It's already up like almost 600 basis points from its low right here. This is goods. All right. And it's, it's up towards the higher end, kind of breaking out. And services are at 4. So service inflation is somewhere between 3.5 and 5. And you're talking about, this is why the Fed doesn't want to cut rates. It is. The problem is it's going to happen anyway. The problem is pushing people away from the dollar with this trade policy. The problem is you're pushing people away from the dollar as it was because China, Russia, and OPEC are now conjoined. We have pushed our enemies together. It's been happening since 2018. Chinese crude oil trades Dubai OPEC-grade crude priced in renminbi, and Russia benchmarks their oil crude to it. Bam, beginning of the end for the dollar. As the petrocurrency, for seniorage, for all these things. And now with the trade wars, we're just pushing all these countries away. Of course, this inflation's coming because we're the largest debtor nation on the planet. And we used to be able to get away with it because we had a strong currency, the reserve currency. Not anymore. End of story. All right, slowly but surely, it's changing. If you think it's not changing because you're not hearing about it in the public press, behind doors, this is probably more urgent than ever for these countries. Sanctions, asset seizures, everything. Anyway, CPI, again, 0.4 was a high number, right? Back onto CPI. Here's back to the federal budget deficit. So you can see again here, we're just talking about, look at how many months out of how many months. You're talking about 63 out of the last 71 months are deficits. Let's talk about the consumer. All right, Michigan survey, current conditions. It's crisis-like levels. The consumer is in crisis. The housing market's in crisis. Labor market is headed there. Credit is in crisis, at least on a consumer level. Commercial real estate's in crisis. Just, nobody's willing to admit it or do anything about it yet. Overall, the inflation expectations, Powell says they're very well anchored. No, not from Michigan. It's certainly not even from the Fed's own surveys. All right. The Michigan 5-year ahead is 3.9. It's the fifth highest in 30 years and staying high, staying above the previous highs, even when it dips. We're talking about credit card balances now because you have revolving credit negative $27 billion over the last 12 months, only the third time in history that's ever happened. Now you have credit card debt from commercial banks, different stat than the Fed's consumer credit. All right. The year-over-year rate of change is 3, which is below the core CPI of 3.1, and that's bad. When credit card borrowing isn't even matching inflation, it's another black hole. It's another way that the consumer is going down without it really being evident, in the top statistics. The other one is the fact that personal savings versus credit card loans, savings dropped again, even since I produced this chart, and credit card debt greater than savings. I mean, again, you've only seen this in rare occasions in history. In history. I mean, Powell's a proponent, a student, a scholar of history, especially Fed history. The fact he doesn't see this, the fact that consumption expenditures outpacing disposable income for months and months. And when you get a rise in income, what do? They spend it on cars because they need cars. They spend it on healthcare. They spend it on food. What do they outspend it on? Discretionary spending, particularly going out to eat and drink, eating and drinking establishments, deflating in the PCE numbers. I mean, this is unheard of. Services running at less than 1.2% annualized for the last 3 months. In terms of spending, versus prices in PCE for services, 4.6 versus 1.2 spending. Do we see how upside down all this is? And here's the really great stat. I showed you this the other day. We saw this in 2007, really fourth quarter 07, first quarter 08, maybe first quarter 08, second quarter 08, forget exactly. But noticed it, talked about it, it was spot on, and we're right here again. That since the end of the third quarter of last year, lending by banks, commercial banks, has fallen $100 billion. Lending by finance companies has fallen by $17 billion. Lending by credit unions, the last resort, the cheapest, the one you go when you can't get credit anymore, anywhere else, up $70 billion. If not for credit unions, total credit would already be in a deflation, and it is certainly already on revolving credit. Now, part of the reason here is this is all stress because what? Yeah, credit card now even ticking higher since this chart was created to above 12%, 90 days seriously delinquent. 12% of credit card balances seriously delinquent. The only other time, global financial crisis. Consumers in a crisis. Revolving credit deflating for only a second time in history. And the Fed is restrictive and says it's appropriate to be restrictive. Consumer crisis, housing crisis, about to hit up with labor market crisis. Expecting inflation to be over 4%, up to 44% of consumers versus October, which was the low in these numbers, only 37%. I mean, look at this. From 37% expecting above 4 to 44% expecting above 4. Now, when you take it compared to income expectations and base it on income, real income, minus 0.6, flat at best for over 100K in income. And the more income and the more educated you are, the higher you think inflation is going to be. But now 100K, the rich sector layer of the income scale, souring rapidly, and this is just one little piece of evidence of that. Let's look at the Beige Book. This is the Fed's own stuff, man. This is what the Fed produces, the research team, for the Fed. So here's what it says. Districts reported flat to declining consumer spending because for many households, wages are failing to keep up with rising prices. Hello? Negative real income, like people expect for the next 12 months. So we think they're going to run out and spend on stuff they don't need right now? They're going to go take that vacation they've been waiting forever to take? No, they get money. They're going to buy a new car because that's what they need. They're going to buy food because that's what they need. And all this while gasoline prices have fallen. Imagine when gas is taking up more of that dollar. Holy mackerel, man. I just don't understand why the Fed doesn't see this. They probably do, and I think probably the stock market's a big part of it. As long as the stock market's the new highs, everything's okay, confidence-wise. I mean, and again, hesitate to criticize the Fed, but at this point, if you don't have a job, the Fed's, that's what they're saying. We don't care about you. You don't matter. Nothing else matters except employment. And if we get job losses, then we might pay attention. Consumers being squeezed by rising costs of insurance, utilities, expenses, other expenses, necessities, things you have to pay for are choking the consumer. Unemployment, Beige Book, telling the Fed, hesitant to hire workers, increase in layoffs, reduced headcounts through attrition, and increased number of people looking for a job. Remember that one, because that's going to be huge. Because what the Fed is saying, it's a low firing dynamic, but it's a low hiring dynamic too. And if you do get fired, you're not going to find a job. So they're waiting for more people to get fired. So Elizabeth Schultz, concerned about the slowdown in jobs. We're getting right to Powell. There's the rest of it. This is Powell. And we'll get to talk about the markets very briefly. So how about the jobs? Well, that's why we became more neutral. There's no such thing as more neutral. That's like Verizon selling me the unlimited package, and then when I get a $900 bill, true story, because my daughter's streaming in her new apartment on the TV, $900 bill, and I call and say, well, I have unlimited. She goes, it's your data charges. I say, well, I have unlimited data. She says, but you don't have the above unlimited or the beyond unlimited packages. I say, do you know the meaning of the freaking word unlimited? Neutral. We're more neutral. There's no such thing as more neutral, and you're not neutral, so you can't be more neutral if you didn't even begin to get neutral to start. Okay, you're still restrictive. And you go on to say, we are restrictive and it's appropriate. So again, typical double talk from the Fed, typical speak with forked tongue. But this was one of the worst performances by a Fed chair. And I like Jerome Powell. Seems like a nice guy. There's no evil intent here. There's no bad intent here. He's an egghead. He's doing what he thinks is academically correct. The problem is he's making the wrong choice for the third freaking time when it really matters. Sorry, that's my opinion. All right? Other people have different opinions. I respect everyone's opinion. I respect Powell's. I just totally don't disagree with it. And I think, in essence, he doesn't realize what he's saying to the average Joe, to the Jane Doe out there, to Mom Pa Kettle, if you remember. I love it. Old film buff, Mom Pa Kettle. All right, so more neutral, ridiculous comment. And then he says, which would presumably be better for the labor market. And then he goes on to say how bad the labor market is. Kids coming out of college, younger people, minorities, hard time finding jobs. The job finding rate is very low. However, the layoff rate is also very low. You have a low hiring environment. So people who get laid off, there won't be a lot of hiring going on. Does he just say this? Is this the Fed chair? And then he says it's been a growing concern for the last few months. Holy shit. Come on, man. Jaw dropping. That's all I can say. Then he gets asked, Colby Smith, this had to be a plant. And then I realized before when I was putting this together, she's from the New York Times. Of course she is. Worst newspaper, worst propaganda shill piece of junk that's out there now. And of course she's from New York Times. I didn't realize that. When she asked this question, it floored me. I couldn't believe it. And the more I thought about it, it's got to be a plant. This is a plant. All right, because no one's going to ask this question unless they were directed to. All right, no way. All right, should we view today's cut as taking out an insurance policy against the possibility that the labor market is at risk of weakening? Guess what, lady? It's weakening already. If you're going to ask an idiotic question, at least ask it without being an idiot about the tone and the content of the question itself. Oh, my God. And he says, yeah, I just gave him his out. This is perfect. This is why this was planted. Yeah, I think you could think of this in a way of risk management, okay? Because if you look at the projections for growth, they ticked up for next year. And employment and inflation really didn't move. Now, first of all, that is a bald-faced lie right here, okay? Employment did move big to the stronger. The Fed just told us in their revisions to the SEP from 3 months ago that the unemployment rate will be lower next year and the year after than they thought. They're saying it's going to be stronger employment dynamic coming out. So this is why this question was planted, to give Powell his out, to suggest especially when we get to the rest of what he said, this was one and done, not the beginning of a new series of cuts. I mean, that's what I don't think the market's still getting that. Here's your changes in the employment expectations for the next 2 years. Where is my pointer? Here we go. I mean, the dotted line was 3 months ago. Look at the dotted line. You had 8 saying it would be 4.6 to 4.70 unemployment rate. All of that shifted down to 4.4 to 4.5. So basically, you could say, just to take poetic and literary license, you went from 4.7 to 4.4 on the unemployment rate for next year. And for the year after, same thing. All of the 4 that we're saying would be above 4.6 are gone. 3 months later, they're all stacked up all the way down here. So it's going to be lower and lower. There's no problem with the labor market, according to the Fed. With inflation where it is, that means no more rate cuts. No more rate cuts. Now, that's believing the Fed and their employment projections, which I categorically do not. And frankly, the market's almost always been right versus the Fed in these kinds of, projections. There's exception in 2022 when they all got it wrong, except for us, of course, and several other people. But now let's look at prices and what the Beige Book says, and then what the Fed says. All districts reported tariff-related price increases, reported rising prices for insurance, utilities, and technology services, broad-based necessities, all right? Described hesitancy, remember I talked about this when it first came out, in raising prices, citing customer price sensitivity, a lack of pricing power, and fear of losing business. Margins take the hit, and stock markets are at new highs. A little disconnect. Clothing retailer marks up 10 to 15%, citing tariffs. Restaurant contact increased because of higher wholesale food prices. Fuel inflation and insurance rates. Well, insurance rates certainly here at the restaurants. And here's the pièce de résistance. You want to talk stagflation? Hotel prices rose despite decreased occupancy rates. Stagflation. Now, Elizabeth Schultz, good question. ABC, prices going up. She has the labor, she has the prices. Or I got the names wrong. I copied and pasted wrong. Could be that she only asked one of these questions. Anyway, what will the Fed do if prices pick up more? Well, let's go to what the rest of what he said. What will we do? We'll do what we need to do. All right? We have 2 mandates. We try and balance them, but the framework is in tension. It's unusual. How do we decide? Our tools can't do 2 things at once. Oh my God, the Fed just said we have stagflation and we can't deal with it because you can't cut rates and deal with deflation. You can't raise rates and deal with the stag. So you got to pick one. You have to pick one. They'll be forced to pick one. They know they're going to be forced to pick one. And I almost feel like they want to have as much ammunition as possible when they have to do this. And then he just goes on and bumbles and stumbles, which you understand. He just said this, and now he's saying, damn, I shouldn't have said that. So what is he going? So, and then that's that. We'll think about these things, and we'll see. Our policy had been really skewed towards inflation, but we're moving in a direction of more neutral. All right, now at least moving in the direction of neutral and say we're more neutral. Again, more neutral is stupid. And come on, Jerome, you're smarter than that. And even we're not that stupid. But then he talks about it's going to be a one-time price increase. All right? And literally make sure that's what happens, that it's one time. And that's their job. So we acknowledge the risks have grown and that we should move in the direction of neutral. But they're not. They're not talking neutral. They're talking, more neutral, preliminary neutrality. And then McKee from Bloomberg, he's hot and cold. He basically calls into question the credibility of inflation target of 2% because we haven't been there forever. All right, we're talking, I think it's 58 straight months or 56, something like that. 54, here it is, 54 months. Since CPI is below 2. So is there credibility? And the hammer comes down because Powell doesn't, you're right. It does say we're going to 2% by 28, but that's how you put projections together. A path designed to create over the course of the SEP, the time frame and write down what you believe you would to return to the 2% goal over at least by the end of the exercise. Are you effing kidding me? The exercise? This isn't egghead talking. It's an egghead. Back engineer everything to meet the goal and fit the data and pay no attention to the man behind the curtain, pulling the levers, printing the money, because that's what they're going to have to do. And we know that now. The wizard has been exposed. The wizard ain't no whiz. Asked about inflation expectations, basically saying, except for Michigan, running at levels consistent with 2% inflation over time. No, they're not. They're 3% or higher for 57 out of 58 months. That's the Fed's own survey. How's that consistent with 2%? You're going to say, well, when the consumer expects 3%, that usually gets you 2%. No, it gets you 2% because you back engineer all the data to fit your exercise. All right? And it's really interesting is what he says. He basically says we can double talk the public to death to will to believe whatever we tell them. Assume that our actions have a real effect that, we need to, continually show and also, mention and discuss our 2% inflation target. So you hear us doing that, basically saying they can talk down expectations. And Mr. Nick, Wall Street Journal, not very well respected here, but this guy is, and follow him on Twitter, Timiraos. He's really good, and he asked the most pertinent question. I mean, this is it. You didn't need a lot of words. He didn't need to preface it to make himself look smart. He just asked the smartest damn question, and the only question that matters. The balance of risk no longer warrant a restrictive policy setting. No, I don't think we can say that, and it's kind of so I don't think we can say. We can say that. Like he's just hesitant and bumbling and stumbling. And then he is down here. He says, I would say we're moving towards preliminary equality. What the hell does that mean? By basically saying it warrants a restrictive policy, okay, and we're moving towards the risk preliminary equality. What the hell does that mean, preliminary equality? I mean, is it transitory equality? Could we revisit that word now? And then it goes on to bumble and stumble and jumble. Maybe they're not quite at equality, but we don't need to know that. We know they're meaningfully moving towards greater equality. Suggests we should be moving in the direction of neutral. And that's what we did today. Now, this is a little bit of a better statement, okay? I mean, they took a step towards neutrality, but they needed to say we're going to get to neutral, that we're going to neutral. Suggests, maybe, still restrictive is warranted. All these things. I know you want to keep your options open, man, but by the time you get there, it might be too late because that's what happened last time. The market's here. The market's almost always been right. 2022, everyone missed the boat. I didn't. They were talking transitory, and me and several other people. I'm not the only one for sure. But then I wrote the piece, Waiting for Godot, the alternative ending, because always it was waiting for Godot, for inflation to come, and it never came, right? 2% inflation. We could dying to get to 2%. Then 2018, 11 white papers, 300 pages, the new policy paradigm, Jerome Powell's in charge. We're going to get inflation. He did everything he said he was going to do, except make the turns at the right times on the back end of everything. And when it was transitory, that was Godot, the alternative ending, meaning in the play, Godot never shows up. Okay, inflation never showed up. The alternative ending is Godot shows up, and that was my whole theme, and it was our theme for a year. It started in 2021 into 2022. I think it was, I don't remember, August, April, I think it was an A month of 2021. I introduced Waiting for Godot, the alternative ending, where Godot, aka inflation, shows up, and he did, and the Fed waited way too long. They're in the same boat now. The market tends to be right, but is the market wrong here? Or is the Fed just being overly optimistic on employment for effect to keep confidence higher? Maybe. I mean, that would be a game the Fed would play. The problem is, you're already so far into it with so many people choking. Now, what's really amazing, though, is to see all the changes in the economy since the beginning of the year, all the things I mentioned that don't matter, that totally matter, but the things that doesn't matter to the Fed, okay? When you're talking about where is the expectations for the Fed funds rate for next year? Well, the low end, you go all the way back to December, then March. I put this together by hand so you can see it. Well, you drop to 2.9. You say, oh, it's a little more dovish. It's one guy. All right. 3.6 is the same high you were back in December. The Fed is basically telling us nothing has changed for them monetarily with all this data we have. And, again, we expect the unemployment rate to be lower. What does Powell have to say about that? Very clear. Hey, look, you got 10 out of 19 who said 2 or more cuts, but you have 9, including some who said no more cuts. One and done is the message here. Whether they stick to that or really mean it is a whole other story. Is it irresponsible? I believe it is. And I believe the Fed has finally lost it. And I believe they're so far behind the curve now that, they don't understand that the next round of inflation is going to be so deflationary on the consumer that it's going to be too late. The dollar's already back on the mat. I mean, let's look at the markets. I really thought, okay, this is one and done. That's the signal. It is the signal. Now, the markets choose not to believe it. I don't believe it. I mean, I don't think it can be. All right, I think they want it to be, and I think they're losing credibility by suggesting it is. And then we wonder if the Fed is not politicizing themselves here. Nonetheless, the dollar, big recovery, and now kind of back on the mat. Watch these levels, 96.21. You take that level out, it's a major sell signal because this will be a major failure off this news to potentially rally the dollar on short covering. Gold and the dollar on a purchasing power basis relative to gold already at new lows today, already at new lows, in large part because gold is soaring. Is this the only place to hide? I mean, you're back into this thing now where credibility to Fed is very close to blown, very close to blown. And now you have a whole nother reason to buy gold. And this is what I've been saying. Wait till the dollar cracks. Gold hasn't even started moving in dollar terms. It's moving in every currency because of gold. Wait till it starts moving because of the dollar. Holy mackerel, all right? Already 41% over the last 52 weeks. The GDX outperforming the S&P by 54%. Again, S&P is not going to keep pace, not like the metals will. Silver, new highs. I mean, what can we say? We've been bullish on silver and gold this whole time. We've been in and out. It's been tough at points. Certainly, there's been a lot of money made on these markets. And the SIL, too, breaking out, up 58% against the S&P. That's 5,800 basis points in 12 months. That's more than 1%, 100 basis points a week for the last year that gold and silver mining shares have outperformed the S&P 500. You don't think Wall Street's going to lemming their way into this one? You know dang well they have already started, and that's going to be big, and that's why Newmont's one of the hottest stocks. And I would add platinum. Seems to be on the verge of making another big move here. Bought platinum this morning for the money management. I'm not buying it for the GMSR, but you can see this would be a new closing high. It's kind of a breakout. It's about to follow. I love the technicals. It's got a supply-demand shortage situation. You're talking about 18 months from now, you're not going to have a heck of a lot of platinum above ground compared to demand, compared to consumption, compared to usage. It's a ticking time bomb, in my opinion. And in that case, not adding it to the GMSR because we're adding gold. You need to own gold. We kept silver was the only position we held over from last week. Back on the short side, the German DAX. I can't get away from it. It looks terrible. Terrible. All the European markets look bad. A rise in the euro, the breakout in the euro, the 4-year high in the euro. All these not good for the European stock markets, and we really see that not only on their own, but relative to the S&P too. So if you want to hedge it, sell the DAX, buy the S&P. I'd rather just be short the DAX. That's it for today. Keep in mind the GMSR is the research that pays for itself.